All right, let me say this straight up right at the start. If you've ever been at a family dinner or scrolling some finance forum and heard someone say, just buy property, you can never lose money in real estate, this video is for you. Because today, I'm going to give you the truth with actual numbers, not emotion, not gut feeling, a calculator. Real estate versus stocks. People on both sides act like their side is obviously right. The property crowd says land never lies. The stock market crowd says compounding is the eighth wonder of the world. Both of them are right, and both of them are also wrong. How? That's exactly what I'm going to break down for you over the next 13 minutes with complete honesty, so that by the end, you'll actually know what's right for you. Because here's the thing, there's no such thing as the best investment. There's only the best investment for your situation. So grab a coffee or a glass of water, because this one's a bit long, but I promise you, you'll want to stay till the end. Let's start with a story you've probably heard some version of. My grandfather bought a piece of land in the 80s for basically nothing. Today, it's worth a fortune. Wow, incredible return, right? Case closed, property wins. Except, here's where almost everyone makes the same mistake. We only look at the entry price and the exit price. Nobody talks about what happened in between. Did they pay property taxes every single year? Did maintenance and repairs eat into that? If it was rented out, how many months sat vacant? What about registration fees, legal costs, agent commissions? And the big one, if that same money had gone into the stock market instead, what would it be worth today? Nobody asks that question because the property story feels good to tell. But investing shouldn't be about what feels good. It should be about what the math actually says. So let's do something different today. Let's break both of these down layer by layer, like an actual audit. No emotion, just numbers.
Let's start with real estate. Say you buy a property for $500,000. Here's everything hiding inside that number that people conveniently forget to mention. Number 1, closing costs and fees. Between legal fees, transfer taxes, and agent commissions, you're often looking at 5 to 8% of the purchase price gone before you even own anything. That's $25,000 to $45,000 vanished on day one. Number 2, if you took out a mortgage, the interest adds up fast. A $400,000 loan over 25 years at around 6.5% interest means you end up paying back close to $800,000 total. That's double the original loan amount just in interest. Number 3, maintenance. Repairs, insurance, property management if you're renting it out. Realistically, that's 1 to 2% of the property's value every single year, whether you're living in it or not. Number 4, property taxes. Every year, regardless of whether the property is generating any income for you. And number 5, and this is the one people underestimate the most, liquidity. If you need cash next month for an emergency, you can't just sell a house. Finding a buyer, negotiations, paperwork, closing, that's typically 2 to 6 months minimum. And if you need to sell fast, you're almost always taking a lower price for it. Now let's talk actual returns. Long-term average property appreciation historically tends to land somewhere between 3 and 6% per year in most stable markets after adjusting for inflation. There are always exceptions, certain neighborhoods that boomed, but those are exceptions, not the rule. And remember, that's the gross number. Once you subtract maintenance, taxes, and interest, your actual net return often drops to somewhere around 1 to 3%, sometimes even less. But, and this is a big but, real estate has one thing stocks don't offer directly: leverage. You can buy a $500,000 property with just $100,000 of your own money, and the bank covers the rest. So if that property appreciates 10%, you're earning that 10% on the full $500,000 asset, not just your $100,000. That massively amplifies your return on the money you actually put in. This is called a leveraged return, and it's the real engine behind real estate wealth. But remember, leverage cuts both ways. If prices fall, your losses get amplified just as much. Now let's flip to the other side, the stock market. The hero here is compounding.
And understanding compounding matters because it's the single biggest reason Warren Buffett became one of the richest people on the planet, not by picking hot stocks, but by staying invested for decades. If you invest in a broad index fund, something tracking the overall market, the long-term historical average return has been somewhere around 8 to 10% per year over multi-decade periods. Some years it's up 25 to 30%, some years it's down 20%, but averaged out over time, that's where it lands. Now watch how compounding actually plays out. Say you invest $50,000 as a lump sum and it grows at 9% annually. In 10 years, roughly $118,000. In 20 years, roughly $280,000. In 25 years, roughly $431,000. That's without adding a single extra dollar, purely from compounding. Now add in regular monthly investing. If you invest $500 a month for 25 years at that same 9% average return, you'd have put in $150,000 total, but the final value would be somewhere around $560,000. That's the real power of the stock market. But, again, another but, there are costs here too that people conveniently skip over. Number one, volatility. Investing in stocks is emotionally brutal at times. In early 2020, markets dropped nearly 35% in a matter of weeks. People who panicked and sold locked in massive losses. People who stayed invested were fully recovered and up significantly within 2 years. Making money in stocks requires patience, and most people simply don't have it. Number two, there's no built-in leverage. Whatever you put in is what earns a return. Yes, margin trading exists, but that's closer to gambling, and I would never recommend it to a beginner. Number three, capital gains tax. Sell your investments within a year, and you typically pay a higher short-term tax rate. Hold longer, and you usually get a lower long-term rate, but it's still a real cost that eats into your returns. Number four, the flip side of liquidity. Because stocks are so easy to sell, people sell too quickly, out of panic, and end up hurting themselves. Real estate's illiquidity is a disadvantage, but ironically, that same illiquidity keeps people from panic selling during the downturn because you simply can't liquidate a house overnight. Interesting, right? The exact same trait is a weakness in one asset and a strength in the other. Let's put these both side by side now. Average long-term return, real estate 3 to 6% gross, dropping to 1 to 3% net after costs without leverage. Stocks 8 to 10% average historically over the long run. Liquidity, real estate very low, takes months to convert to cash. Stocks very high, sellable in seconds any trading day. Entry amount, real estate you typically need tens of thousands minimum. Stocks you can start with as little as $50 to $100. Leverage, real estate easily accessible through a mortgage. Stocks risky and I don't recommend it for beginners. Effort required, real estate active, finding tenants, handling repairs, dealing with legal issues. Stocks passive, invest once and largely leave it alone. Emotional difficulty, real estate lower because you're not watching the price every day. Stocks higher because the price is visible constantly and people make emotional decisions. Diversification, real estate difficult, your money's locked into one property, one location. Stocks easy, you can spread across sectors, companies, even entire countries. Looking at this, it seems like stocks clearly win, right? Numbers-wise, yes, but let me show you a real example where real estate actually pulled ahead. Two friends, let's call them Mark and Alex. Back in 2010, both of them had $40,000 saved up. Mark used that $40,000 as a down payment and took out a mortgage to buy a $160,000 house in a growing suburb. Today, in 2026, that same house is worth roughly $440,000. He's paid off the mortgage, so his net worth from that one decision sits at roughly $440,000 in equity. Alex took his $40,000 and put it into a broad index fund and then kept adding roughly $300 a month whenever he could over the years. Today, in 2026, his portfolio is worth roughly $520,000. Both of them did well, but here's the key difference. Alex's money is liquid. Tomorrow, he could pull out $100,000 without touching the rest. Mark's money is locked into one asset. If he needs cash, he either has to sell the whole house or take out a loan against it. And here's the interesting part. Mark's outsized gain came almost entirely from leverage. He put in $40,000 and controlled a $160,000 asset. If he had put that same $40,000 directly into the market and never added anything else, the number would look very different because the real power came from leverage, not from real estate's underlying return rate. So you see, the answer isn't as simple as people like to make it sound. Now let me give you my honest take based on everything we just walked through. If you have a large lump sum, you want to use leverage to multiply your return, and you need somewhere to actually live, real estate is a genuinely solid choice, especially if it's your primary home because you're also saving on rent, which is a hidden return most people never count. If you're younger, have a steady income and value flexibility and liquidity and can stay disciplined, the stock market, especially through low-cost index funds and consistent monthly investing, will very likely build you more long-term wealth with far less hassle. And honestly, the answer is that this either-or question is the wrong question in the first place. Smart investors do both. They buy a home to live in, which is an emotional and practical decision, not purely an investment one, and they systematically put the rest of their money into the market through consistent, long-term investing. Don't treat real estate as a pure investment unless you're also using it, because the hidden costs, maintenance, taxes, and illiquidity are very real. And don't treat the stock market as a get-rich-quick scheme either, because it demands patience and discipline that, frankly, most people don't have. So that's the full, honest, number-driven breakdown of real estate versus stocks. No bias, no sponsor pushing me one way, just the math. If this was helpful, drop a like because it tells me to keep making deep, honest breakdowns like this one instead of surface-level content. Let me know in the comments, which side are you on? Team real estate or team stock market? Or, like me, a bit of both. And if you want more deep dives like this, SIPs versus lump sum investing, or index funds versus picking individual stocks, subscribe. Hit that bell because there's a lot more of this coming every week. See you in the next one. Until then, invest with your brain, not your emotions. Take care.